Hey guys, Tom here from the Investing with Tom YouTube channel. Welcome back to the channel. If you enjoyed today's video, hit like, hit subscribe, and that way you can see future videos as well. So I've been investing personally in the stock market for a few years now, and I think like many people, the first person I really discovered who was a very successful and very wealthy investor in the stock market was, of course, Warren Buffett. But after investing for a few years at this point, I've discovered many other investors who also happen to have very successful long-term track records. So the next person that a lot of people find is Charlie Munger up here, but there's many others. There's obviously Ben Graham, there's Bill Ackman, Phil Town I've learned a lot from, Monish Prabhai, Guy Spear, David Einhorn. The list goes on and on of all these very successful investors, and what I've learned over the past few years is that many of them have a lot of common traits that really make them successful. So for this video, I've put together my top 5 traits for successful long-term investing. So I want to get into that, talk through my sort of list that I've put together. So do hope you enjoyed the video. Please hit like if you do. That really does help the channel, and let's get straight into it. So trait number 1 for being a successful investor, and one of the things that I learned very early on, is to focus on the underlying assets. So I think there's a tendency in stocks and when you're buying shares in public companies to focus on what the share price is doing or has done in the past. I know that for me personally, when I made my first couple of investments, it was literally looking at a stock chart and seeing it go up to the right and saying that must be a really good investment. But that is certainly not the way to do it. We need to focus on the underlying business, because at the end of the day, when you buy shares in a company, you are buying a small piece of ownership in that business, and you need to treat it as such. You need to treat it just as if you were going out and buying a private business or a piece of real estate, and really understand what's the business going to produce and return to me as a shareholder over the long term. And that's a massive mindset change. It takes you away from thinking of what investors are going to do next week or next month, and what news may come out around the company. Are they going to have a good earnings report or a poor earnings report? And it really puts you in the mindset of just being a long-term owner of a business, and not really getting scared by big fluctuations in prices, because if you owned a piece of real estate and you bought it for $300,000 and then someone turned up the next day and offered you $250,000, you would not sell to that person. So it really gets you away from the short-term mindset, and it just really helps you focus on what truly matters for long-term returns, which essentially is what the business does. It's very hard to make good returns when the business you own doesn't do well. And vice versa, if the business does very well, it's hard not to make good returns unless you really overpay for that business. So that is the first trait of every long-term successful investor that I have come across, is they focus on the underlying assets and they buy things exactly like they would buy a business or a piece of real estate. Trait number 2, and this is one that we have been seeing Warren Buffett implement for the last few years really well, and that is patience. Now, patience is massively important to long-term investing, because we really need to understand that, particularly if you have sort of a value investing mindset and you're trying to buy attractive businesses at equally attractive prices, then opportunities, really good opportunities for excess returns, really good returns, don't come along all that often. And patience is basically a prerequisite to avoid doing anything stupid and pulling your long-term returns down. So patience is definitely key. The reason I say we've been seeing Warren Buffett do a really good job of that recently is because he has built up this massive cash pile within his company Berkshire Hathaway. We have seen him say very clearly that he believes a lot of companies are very expensive, both private and public, because he hunts in both of those areas. And it's meant that he's basically just been sitting there waiting, and he's had the odd opportunity come up over the past sort of 5 or 10 years. He made a lot of investments in 2008 and 2009 when the stock market got very cheap. He made a massive investment in Apple in around 2016, but he hasn't really done anything massive since. He recently just did a $10 billion deal, which is a huge deal by almost anyone's standards except Warren Buffett and Berkshire Hathaway, and he's still just sitting with a lot of cash like many value investors are. I know that someone like Phil Town is like 60% cash or something at the moment, possibly even more, in his Rule 1 fund. So there are a lot of really good investors just holding on to cash and basically waiting for opportunities. And that is a really core principle that I think a lot of value investors stick to, is just be patient. If you underperform the stock market over the next 1 or 2 or 3 years, it doesn't really matter a huge amount if you can pick up companies extremely cheap in year 4 and 5 and produce, like 40% a year or something for the next 5 to 7 years after that, because you got spectacular deals. So that's kind of the way that I think about things, that I know Warren Buffett and Phil Town think about things, and that is my number 2 trait of successful investing. Now, my number 3 trait for pretty much every successful investor on this list is to have a value bias. And what that basically means is that you base your fundamental investment strategy off what you think an underlying asset is worth. You're not someone who speculates in non-productive assets like gold or silver or cryptocurrency or anything like that. Or even non-productive businesses, so unprofitable businesses and those sorts of things. You're someone that focuses on what something is fundamentally worth, and you're able to work out what something is fundamentally worth to you based on the cash flows that it produces. This sort of ties into point 1 and 2 around focusing on the business and having patience. What it basically means is that you put together a list of companies that you understand really, really well. You put some sort of intrinsic value on them, and you buy them only when they get to large discounts to that intrinsic value. And that does 2 things. The first thing is it means that you have a pretty good understanding of what return you're likely to make out of that investment. If you know something is fundamentally worth $100, and let's just say it's a company that doesn't grow, so it's pretty much always going to be worth in and around $100, and you can buy it at $50, then you have 2 things happen. So you know that you're going to get a pretty good return because you've got a great deal, and over time market prices price things in and around their intrinsic value. And the second thing is you've protected yourself from a lot of downside. So unlike buying a high-flying, non-profitable company and just sort of being fingers crossed that this business does really, really well in the future and justifies the price you pay for it, you're doing the reverse. You're looking at protecting your downside. If you can buy $1 for 50 cents, you can buy something half off. You protect yourself from losing money over the long term. That doesn't mean your stocks won't go down and be in the red for periods of time and that sort of thing. But it's unlikely that if you buy something that's truly worth 100 and you pay 50 for it, that it's going to go down to 30 or 25 or 10 at least over the long term. And if it does, and you're correct in your analysis, then you've set yourself up for a great opportunity to purchase even more of that underlying asset and create even larger returns over the long term as that price does appreciate back up to intrinsic value. So that's trait number 3, is to have a value bias and have that be sort of your core focus when you're looking at particular investments. But trait number 4 for being a successful long-term investor in the stock market is to have a core strategy that you stick to religiously, and you avoid something called style drift. Now, style drift is basically having some sort of core strategy. Maybe if you're a Warren Buffett style investor, that is something like buy wonderful businesses at fair prices, and then you see this cigar butt come along, something that's really, really a terrible business, but it trades at an even more terrible price, so you can buy it really, really cheap. Sort of older school Warren Buffett, Ben Graham style investing. If your core strategy is to buy great businesses at attractive prices, and then you see yourself leaning over towards these really, really discounted businesses, that is something called style drift, and that is you getting away from your core strategy. Now, over time, we've seen Warren Buffett move from the cigar butt investing to the long-term investing in more high-quality businesses, and that's an evolution of a strategy, but still he has stuck to those core strategies over time. So in his early days, he was really stuck to the cigar butt investing. He sort of evolved into the higher quality business investing as he got larger, and he couldn't get in and out of these small companies as easily just due to sheer size, basically, and a bit of influence from Charlie Munger as well. And it means that he's really stuck to his core strategy. So you will pretty much never see Buffett, I guarantee you will never see Buffett come out and pay 200 times earnings for some tech company. It's not a business he understands, and he's just not likely at all. It just won't happen that he'll pay that much for a business. He is really, really focused on buying high quality businesses at attractive prices. Pretty much end of story. So he avoids style drift. He doesn't find himself drifting into commodities. He doesn't find himself speculating in something short term. He doesn't find himself paying huge premiums for companies with a great story but really no fundamentals, and he just sticks to his core strategy. So if your core strategy is a little bit more Buffett-like, please don't find yourself getting into these, really high valuation businesses that just don't produce the cash to justify that. Right now, or even into the future, they would have to just pull off spectacular things to justify those valuations. If you're getting into that, you're getting away from the margin of safety and from the focus on the business and all those sorts of things. So that was trait number 4. Let's get into trait number 5. So trait number 5 for successful long-term investing is to be an absolute learning machine. And Warren Buffett has been a stellar example of this. He's someone who basically just sits in his office and reads all day, as he describes it. And he's really just trying to learn more and more over time. You'd think that at 90 years old, his memory card would be getting pretty full, but it's not. He keeps being able to cram more and more information in there and process it all very, very well. And it's something that I've been trying to do over the last few years as well. So I'm a pretty big reader, or at least I try to be. Been slacking with that this year, as I've discussed in a previous video, but I try to be a good reader. I listen to a lot of podcasts on investing. I follow what successful investors are doing through things like their 13 Fs and just blogs and news posts they put out, and I follow the news and kind of what's happening in the world. And over time, those little nuggets of information add up. I follow sort of Charlie Munger's advice to try to go to bed each day a little bit wiser than when I woke up. And 30 minutes reading or listening to a podcast or whatever it is can really help you achieve that goal each day. And in the short term, it might not seem like that much, but over a year it adds up, and over a few years it really adds up, and it starts to compound, and you start to kind of link all these different areas of investing and kind of what's going on in the world all together, and it just makes you understand businesses and all the things that we need to understand to be good investors much more succinctly, much better over a long period of time. Now, when I look back at my own investing portfolio and philosophy a year or 2 years ago, fundamentally the strategy hasn't changed. I'm still trying to buy a dollar for 50 cents, but I've been much more intelligent in the way that I understand that. I've got much more of a regimented process that I kind of walk through. I've pretty well locked in the methods that I use to value companies, and it just has made me a more regimented investor over time. And I think I will continue to get better as I continue to learn and learn and learn. And it's a never-ending process, whether it's investing or any other aspect of life. Learning is massive, and that is my 5th and final trait for successful investing. So that's my top 5. Let me know in the comments what you think. If you think there's anything obvious that I've missed, definitely drop them down in the comments below. But that is all from me today. So please hit like on the video. It helps the channel out quite a lot. If you're interested, you can watch some older videos over there. Hit subscribe over there. Otherwise, I will see you in the next one. Cheers.